Hi, this is Brett Kepler with TREO Realtors. Thanks for checking out another edition of Coffee Time. It's tax season, yay! So if you're like me, you totally dread doing taxes because your accountant's going to come back and say, you owe X amount of dollars, please write a big check for me. Or if you're lucky, maybe you get money back. But there's one thing that we can agree on. We either want to pay less or we want to get more money back. And the best way to do that with your taxes is through taking advantage of tax breaks that exist out there. One of the best tax breaks that exists is by owning real estate. Okay, so there's 5 main ways that you can actually reduce the taxable income that you have through real estate. So the main ones are through your interest that you pay on your loan. So if you get a mortgage in the beginning of the loan period, it's like 70–80% of what you pay each month is actually going towards interest. And you can write the entire year's interest off on your taxes. The second one is if you take out money on your house for a line of credit to actually improve it, or if you do one of those 80–10–10 loans or something where you're actually borrowing a second mortgage to help pay for the property up front, you can write off all of that interest. Okay, so if you decide to borrow money, put it in a pool, you can write off that interest on your taxes. Now the third way, and another big savings, is by being able to write off your property taxes. So whatever you pay throughout the year, by owning that piece of property to your local government or your county government, you can write off all of that as well. And there's a couple smaller ones. You can write off origination fees on a loan purchase, and there's occasionally some tax credits you can get for energy efficient items. Currently, the only one that I think exists at the moment is for natural energy, whether it's solar panels that you install, or if you put a windmill in your house or something, you can write off 30% of that cost on your taxes. Okay, so those are 5 great ways to save money and to immediately reduce the amount that you owe. Now, the other big tax advantage is not really a write-off, but it's more of a benefit, and that's through capital gains tax. So if you don't know what capital gains tax is, basically anything that you own that increases in value, whether it's artwork, maybe vehicles, antiques, things like that, as those go up in value and you sell them, you make money, the government always wants a piece of that. Okay? With housing, believe it or not, it actually can go up in value. I know it didn't for several years there, not too long ago, but it's going back up in value again. If you're a single person, you're exempt up to $250,000 of increased value from having to pay tax on that. And if you're married, you're exempt up to $500,000. So if your house goes from being worth $500,000 when you buy it to being worth $1 million, 30 years later, you're not going to have to pay any sort of tax on that gain once you go to sell it. So that's just money that you can put right into your account. Now there's some additional terms and conditions for these things, but I'm not going to get into the boring details. Okay? So if you're currently renting and you're saying, well, that's great, but how's that really going to affect me? Let me do a really quick example of how owning a house versus renting can actually save you money. So let's get rid of this background here. All right. So over here on my right-hand side, I'm going to put up a little equation. Now let's say that you make $50,000 a year. Okay, and the average that you're going to pay in taxes for federal and state and all that is about 30%, right? So of the $50,000 that you make, if you're paying 30% of that out in taxes, you're paying $15,000 right back to the government through your tax payments. Okay, now if you want to actually bring that $50,000 number down, you can do that through write-offs. Now let's say that you are paying $1,000 a month in rent and you decide to go and find a house that costs you $1,000. So you could get approximately a $150,000 house, 4.25%, and let's say that you're paying $250 a month in property taxes. Okay, so that's going to be about $1,000, and what that's going to result in is actually interest for the first year is going to be over $6,000, and the $250 a month that you pay in property tax is going to total $3,000, which means you're going to have $9,000 of interest write-off just by owning that house. So what we do is we take the $9,000, we subtract it from the $50,000, and you're going to end up with only a taxable income amount of $41,000. Okay? So now instead of 30% of the 50, it's 30% of the 41,000, which gives you a tax difference of $12,300. Compare that, subtract that, from the $15,000, and that's $2,700 in savings. So that's how we get there. That's $200 a month, actually a little bit more than $200 a month. That can go towards a car. It can go towards, you can pay your house down even faster. You can take a vacation. There's a lot of great things you can do, but ultimately you're going to save even more money by owning versus renting. So if you're ready to take advantage of this type of a deduction, reach out to myself or someone from my team. We'd love to help you buy a house so that when you file your taxes in 2018, you'll see huge savings. Thanks so much. Have a great day.